We are going to be transitioning to the next panel almost immediately. So I would request Mr. UK Sinha, Naina Lal Kirwai, and Mr. Sriram and Mr. KP Krishnan to come on stage. Okay, thank you everyone for being back for our financial institutions panel. So the last few years have been testing times for the Indian economy, particularly in the financial sector. We've almost been barraged nonstop about rising NPAs, declining bank credit growth, NBFC crises, and regulatory failures in monitoring. And these are just some of the problems which have emerged. At CPI, we've been working on trying to build up a research program on infrastructure and finance, and we've done a few events and are coming up with a few policy notes in this direction. And we hope this panel will spur some ideas in this future direction, and we're very happy to be working with Dr. KP Krishnan on some of these ideas as well. So I'm going to hand this over to Dr. KP Krishnan and his very distinguished panel, which includes Mr. UK Sinha, former chairman of the Security and Exchanges Board of India, Ms. Naina Lal Kidwai, former chairperson HSBC India and senior advisor Advent Private Equity, and Mr. B. Sriram, former chairman SBI and IDBI and currently a board member at ICICI. This is a pretty jam-packed panel with over a century of experience in Indian financial markets, so I'll leave it to KP to take this forward.
Thank you, Rohit. Good afternoon, friends. On behalf of CPR, it gives me great pleasure to welcome you all to this afternoon's panel. The topic is India's financial institutions in crisis, understanding India's economic slowdown. I think, as Rohit said, we are truly privileged to have with us for this discussion an outstanding panel of professionals who've perhaps between them dealt with every part of the financial system and can, I think, help us construct a complete, a comprehensive, and a candid view of the current problems and possible solutions. Also a matter of great personal privilege and honor for me that I'll have the opportunity to re-engage constructively with personal friends and long-standing professional colleagues. Madam Naina Lal Kidwai, Mr. Sinha, and Mr. Sriram. They don't need introduction, and let me, on behalf of CPR and all of you, welcome to this discussion. We have about a little less than 90 minutes for this topic, and what I propose to do, with your permission, is to set the context. I'll probably take 6-7 minutes and pose what I think are a set of relevant issues. I will then call upon each of you to make your initial remarks a little under 10 minutes each. And you can deal with some of the issues that I raise, and you can deal with additional issues which you think are relevant. My expectation is we'll be done with all this by about 40 minutes or so, and we'll still have enough time for the sort of round of questions and answers. The attempt would be to, excuse me, also to try and get each of you 5 minutes or so to make concluding remarks based on the discussions. To begin with, high levels of savings and investments are clearly, I think, without any doubt, acknowledged as the key to India's sustained and robust long-term growth. While India's savings rate has declined in recent years, I think a much bigger challenge facing the economy is the efficient intermediation of what continues to be a substantial amount of savings to finance growing requirements of India. Now, to look at some, very quick look at some data, as a proportion of GDP, total savings in India increased from about 23% in 2001 to a record of 34, close to 34% by 2010, before declining to about 30% as a percentage of GDP in 2017. Household savings, which is a component of this, shows a similar trend. While this itself, this decline is not a happy trend, I think the financial sector clearly cannot be held responsible for this. On the other hand, I think the low proportion of financial savings in the overall savings portfolio of the Indian households. It's about 10%, and it has been about 10% for a while now. Clearly something which I believe can be laid at the door of the financial sector. And this is especially so when we look at comparative sort of countries. For instance, take Brazil. Brazil actually has a lower proportion of its savings, a lower proportion of its GDP in savings compared to India vis-a-vis household savings, but pension assets of Brazil are 12x the size of Indian pension assets as a proportion of GDP today. Likewise, insurance premia in Brazil are a little over twice the insurance premia as a percentage of GDP in India. So, question one that I want to pose to the panel is, has the Indian financial system been less than equal to the task in terms of sort of meeting the objectives, addressing the needs of the Indian households? And I think closely related is a question which bothers a lot of us. Is it partly because of the weak consumer protection in Indian finance, which has made the Indian households wary of putting their savings in the financial sector? Recently, some of you would have read, Mint ran a 5-part series starting on 2nd of December, which was titled, How Indian Regulators Have Cost You Money. Household savings have been wiped off from under the nose of financial regulators in India. This is the title of a 5-part series. I don't want to go into the details of the 10 big scams that they talk about, ending with the latest Carvey brokerage related set of issues. But I want to stop here in terms of posing issue number one. I'll come back to issue number two, which is on infrastructure financing, MSC financing, another known big area of gaps in Indian financing. Maybe I'll just touch upon it without throwing too much data at you. Clearly, I think infrastructure financing, the way it was done in the last 10-15 years, is clearly one reason why Indian banks are where they are today. So, is this forcing of Indian banks to do what they are not meant to be doing in the first place a part of the problem with financing overall today? Likewise, on MSMEs, we all have the data in terms of how important they are in India's GDP, in India's employment picture, etc., etc. But as per the RBI's own data, only about 5% of non-food credit of scheduled commercial banks goes to the MSMEs. And more important, this number has been declining the last 2.5, 3 years. And clearly compared with OECD countries, this is much, much less. So one core activity for banks, which is financing MSMEs, because the bulk of them are unlikely to have access to the bonds market. So in banking, will it be right to say that we seem to have got it exactly wrong? Indian banks do not fund those who need bank funding and fund exactly those who should not be funded by banks. So question number two, and given that this is perhaps one of the most regulated and controlled sectors of India, is what we are seeing, A, consumer finance related issues that I set out, and infrastructure and MSME financing issues that I've just mentioned, is it the result of faulty policies and regulation? I'll stop here. Can I request Madam Naina, the only private sector representative, at least formally, the longest standing private sector representative on our panel, to start with her remarks and an answer to these two questions.
So, KP, I feel totally set up by that introduction of yours. I have beside me one of the people who was a regulator in my time at the capital markets, even as I worked in banking, and KP here, who I work very closely with at the ministry. And I think the one space, is this here? Yes. Yeah. The one space which has not got mentioned by KP, but I think we should bring into this discussion, is the issues with the banking sector get interrelated with the lack of a developed debt market. Spaces with both KP and Mr. Sinha have worked closely in. And I like to set this out at the beginning because KP mentioned the issues on infrastructure and have banks been funding what they shouldn't be funding. And I would say absolutely, because what was lacking was the ability of long-term financing, which is needed by the infrastructure sector, to be provided by the debt markets. And the debt markets being virtually, I would say, non-existent for longer-term financing, as in the 7 to 20 year space. And we ended up with infrastructure often being financed by the banks, which at best do up to 5 years, because that is typically the deposit profile. And the mismatch in banks then happens when you have the 5-year deposit funding the 20-year infrastructure. So the issue is with our debt markets, with the ability of a banking sector to come in, as they did in the past, but in the process, to have a takeout, which should have really been the takeout provided by the debt markets.
Yeah, the coffee is for you.
Sorry about that. So maybe I can come back.
Okay. So while you recover, ma'am, can I request Sriram that I'll come back to you at the end for a good set of reasons. Can I ask Sriram, a career SBI banker who was MD SBI, who ran, I think, IDBI for over a year? Few months, yeah. And then now with ICICI Bank, he probably handled every vertical inside the SBI and done very challenging assignments, been a part of a number of expert committees. While we come back to this question about the corporate bonds issue, I expected that the discussion would take place as part of the answers. Can I also request you to focus on this $1 million elephant in the room, public sector banks?
So, thank you first of all for having me here, and it's also very nice that policy researchers are also looking at finance and banking, although I didn't see it in this sort of display which is there. But it's, I think, a huge topic that needs to be discussed and looked at. So there are three questions that KP has asked. One is, of course, on public sector banks. The second is on infrastructure finance, and the third is the savings, the lack of savings, or the not increasing savings that is not happening. So I will try and dwell a little bit on all of these three. The first problem was on infrastructure, which started off in sometime in 2006 or 7 in a very big way. And at that time, I would imagine that in some way, the mistake that we made coming out of the reforms, which said that the developmental financial institution should be converted into sort of a universal bank, the universal banks or the commercial banks were unable to take up that role. But the fact remains that in their developmental role, the DFIs did not come out, very, very successful for various reasons, which we can talk about later. Commercial banks, they took up purely because some of the DFIs had converted into commercial banks, universal banks, and they did have the expertise of project finance and infrastructure lending while they were in DFIs. So there were new departments that were set up in many of these banks, which had those specialized skills, and they thought that they probably were in a better position because the cost of funds of commercial banking is far less than DFIs. And in that sense, probably one of the key areas of viability of infrastructure finance or project finance was in terms of how soft an interest rate can be given to the company which sets up these projects. But I think the experience has shown, not only due to lack of skills or the lack of liquidity or to the fact that there has been an ALM mismatch, but also due to the lack of various other things that were unanticipated in infrastructure finance. Maybe governance issues, could be cancellation of various givens that were applicable at that time, maybe forecasting GDP growth and forecasting traffic was wrong. So a combination of all of them has actually led to a problem situation which we have gone through the last 4 or 5 years. And the third aspect is that there are specialized infrastructure companies, specialize on certain funding. Like, for example, the power sector, we have very specialized finance companies. We have specifically certain NBFCs who are specializing in certain types of infrastructure finance. But the problem was not that one of them has done something better, but the person or the institution which is standing up straight today are the people who did not touch infrastructure or project finance. So that is why the question as to what went wrong, multiple things went wrong, and it's time for us to just sit back and now see as to where do we take infrastructure finance and how do we do that. Because for a 5 trillion economy, today if you see total credit in the banking system or banking and non-banking system is upwards of $2 trillion. If you have to make that the second leap, you are looking at about $1.5 to $2 trillion more over the next 4 or 5 years. And this cannot happen if all the financial system is bent on doing digital and retail banking. So there is a problem there, and in some way, I would imagine there is a crisis there in terms of people not addressing or not learning from what has happened and trying to build on it. Rather than doing that, actually people are withdrawing from the system and saying that no more corporate finance, no more project finance. All the expertise that we had built up on all of this in terms of skills, capabilities, capacities, have actually gone into digital finance. I would imagine a day when when we talk about digital financing, the first initiatives that happened in digital banking was in the corporate space. It was in cash management, it was in trade finance and so on. But then all of that has gone out of the winds, and today, if at all we are trying to build a country for the future on the way that we are going, I think a digital probably for project finance is something that we have to look forward to. So that is one. The second is, of course, the area of public sector banking. Public sector banking has been always the whipping boy for many of the sins. One of the problems that we have and we face is we are not sure whether we are a developmental institution or whether we are a commercial institution. If we lose money, we say that we created all these assets for developmental work, and the risk is high. And if we do well in certain parts, we have done very well. We say that it's all because of the expertise that we had and we did well. To a large extent, you find that the human skills, that have gone into the banking system have gone out of public sector banking. If you just go back 10 years ago, 15 years ago, many of the banks which are today doing well have skills drawn from public sector. But the problem with public sector is twofold. One is the non-distinction between capital and deposits. If I don't, if I get a good sleep, not thinking about capital and saying that, look, capital is as good as assured for me because the government is going to step in at one time or the other, I don't think I do a good job on it. I have to lose sleep. I have to make sure, and that is something that is today being witnessed by the public sector banking system, but it was never there as part of the culture of that. The second is in terms of keeping up with current trends. For example, investment in technology. If you leave aside SBI to some extent, but none of the other banks are anyway even comparable to NBFCs who are highly tech-driven. And even if you want to position yourself as a retail bank or a regional bank, you need to make sure that your technology, and in terms of today we are saying that directionally, most of the credit lending and credit is going to be driven through digital means and analytics and so on and so forth. If you are not prepared for that, I think you will lose out in the competition. There was one, I will tell you in an episode of one housing finance company who came in and said that we were talking about housing finance, and he said the only competition comes from private sector banks, and the only competition comes from SBI due to its network and due to its brand or whatever it or interest rates. But we don't see public sector banks as competition. And when I asked him why, he says after there is no incentive for number one for these banks to do anything worthwhile go on, and marketing and sales is something which is complete anathema to public sector banking. So the question again comes back to whether the public sector bank has delivered within the constraints that we have faced. Two big constraints. One, there's nothing like an incentive that can be given to public sector banking. And there's nothing like a penalty that you can force on a public sector banking employee. And that's why I keep saying, when you say internally, is that when you select somebody from the market or from into the bank, at the time of selection, you're actually selecting him or her for 40 years. You're not selecting a person and then evaluating a person for 5 years, 10 years, and see whether he fit into the banking space or not. You're selecting him and you're stuck with the person for 35, 40 years. So the problems are many. Some of the few things that I wanted to highlight, I've highlighted. And finally, the consumer space. I think as a vehicle for mobilizing savings and deposits, reasonably, I would imagine the banks have done reasonably well in the sense that the comfort of a deposit in a public sector bank, as I said, the distinction between capital and deposits is very, very thin. And to many, including the most learned, deposit in a public sector bank is akin to a sort of a certainty of repayment. The problem is that over periods of time, and you will see periods in the early 2000s or even now, for example, many of our deposit holders who place deposits are in the line of trying to derive income from it for their monthly expenses. And in that sense, at 8, 9, 10% interest rates was something which was a given. And I think senior citizens were enjoying about a 1% more interest rates as against others. And an interest rate of 8 or 9% was a sustainable interest rate for many of them. Now, when the interest rate started to fall, and it has fallen over periods of time to 6%, 6.5%, and take away 30% on tax over it, there's hardly any incentive for somebody to try and invest there. And that's why there is a channeling which goes out. Today, if you see the sort of SIPs that happen in the mutual fund, Dr. Sinha will will probably be elaborating more on it. The sort of channeling that goes to other financial assets other than banking have been far, far higher. And whenever there is a crisis, and I would imagine there were a lot of crises in the recent future, the intention of a saver has always been to move towards safety. And that is again gold, that is again, in some way, public sector banking space in some way. So these are issues that are there. I'm sure there are many issues that we can discuss, but I think for the time being, I thought.
Thank you. Thanks, Sriram, for two things. Thanks for answering the question on public sector banks and being bang on time. I'll now go back to ma'am. You were on corporate bonds, and since Sriram touched upon public sector banks, can you also, in your remarks, try and speak about what we are now seeing in the private sector banks? We thought that was an area of great success. Now, clearly, there is bank after bank, which seems to be, quote unquote, getting into some kind of trouble. Is it entirely a supervision problem? Is the regulator entirely responsible? Or have we also got private sector banking wrong?
Okay, and that choking fit was really an emotional one. So we are clearly not where we need to be with the banking sector, and it's actually pretty frightening. In fact, I will just reference back to a book I put together called Contemporary Banking in India. 2013 was when I done it. So in my foreword there, and it has many experts commenting there. So I actually say that if we do not sort through issues in the steel sector, the power sector, and real estate, we are going to be seeing a crisis at a level which the banks are going to have NPAs beyond what they can deal with. So it was obviously staring us in the face even then, if I felt brave enough to write about it. And we are where we are today for what it is. So it's there. These problems are there. They've come exactly as Sriram said for a bunch of reasons. You all know it well, so let's not dwell on that. But not all of it the fault of banks or the fault of the companies. Sometimes very much because the regulatory environment also for that sector had an issue. But I say all this because at the end of the day, your banks can only be as strong as the economy and as the components that make up the economy are. We need strong companies, we need strong industrial sectors, we need strong regulators, and the banks really only benefit or not from how the strength of the economy is. So yes, the fault may also lie with the banks in that they perpetuate what is wrong, but they also unfortunately get affected by what is wrong. Now, you asked the question on the private sector. So we've got some great private sector banks out there. I mean, you look at the multiples at which an HDFC quote, how well an ICICI does, Axis. There has been, as a result of the opening up of banking, some really world-class private sector banks that have come up. There are others which are having their share of NPAs, but then which bank isn't? And I think that is the issue of the banking sector per se right now and what we face therein. The good news is the private sector can go out and raise capital. At some price, somewhere they can go out and raise capital. What has happened with the public sector banks was when they could have raised capital at a much better price than what they would have today, because they were constrained, because of government holding, and dare I say even a dog in the manger approach by government, they didn't go out and get the capital. And now when we are on our knees to try and raise capital at prices which are extremely dilutive, of course, for government and indeed for the banks, it's a shame. But the fact is, at the end of the day, they are starved of capital. That capital is required. And at the end of the day, well-capitalized banks are what create a strong banking sector. So the private sector banks opening up, I think, has been great. I think consumers benefited. Did they fill the space which Mr. Sriram rightly highlighted, which is infrastructure? The answer is no. The reason they're standing and they're doing well today is they didn't go down the track of project finance and infrastructure for some of the reasons we've already highlighted. On the other, uh, great success stories. If you look at HDFC's success story, it is built around MSMEs. They didn't fall to not just infrastructure, but doing large financing of big companies in India, which then defaulted. So having the MSME range of financing that an HDFC developed was a big positive. So there's lots of learnings there, some good and lots of good ones in the private sector to my mind, but clearly lessons that have to be drawn on. There were gaps across the banking sector which the NBFCs went in to fill, which was also important. I think the wheels of finance as they went in to fill the holes, which the NBFC did, were also positive. The fact is that too much growth, over leveraging are issues which any regulator has to be mindful of and begin to hold back. And at the end of the day, the entire country, Prime Minister downwards, become responsible for bad NPAs because it is usually a reflection of an economy that is beginning to get stuck. And I think that's where piecemeal going forward, we have to address the sectors which have caused the problem. And it's working. The steel sector is a classic example where thanks to the NCLT process working, and I believe it is working, never working fast enough, never as well as we would like, but it's working. So let's give it credit where it's due, where the first of them saw 85 to 90% of the loans come back to banks, NPAs, coming back to banks, saying that at the end of the day, that company was fine, whether it was, you know, a Bhushan Steel or whichever, Electro Steel, that the companies had enough attraction to big companies, whether Tata Steel or Jindals or whatever, to go in and acquire them and to give the money back to the banks. So the answer has to be that the banking sector has to see on the other side a robust mechanism for retrieval of funding, and the NCLT provides that. But what it does not provide, and I think we have a huge gap, and I think one of the questions, KP, which I do hope we are going to focus more on, is the way forward, is the interim bit, which is as the patient is evident, you know, you've got your cough and cold, but you're not yet etherized on the patient's table, as in, you know, declared perennially sick. Is there a space where we can jump in? Not, but it's not necessarily banks, but banks providing a mechanism where it may even mean taking a haircut, where you jump in and you create a situation where you can pull the company up by the bootstraps before it gets into the sick zone, and that area does not exist. It requires risk-taking, it requires decisions, essentially by bankers, sometimes to take haircuts in their balance sheet. The system today just does not provide it. And it is that mechanism which I think is key. A critical example of this where it worked, but the government can't work on that every time, is Satyam. A perfectly fine company with a problem created by a promoter because he went into real estate, created these huge issues therein in terms of what Satyam could have become, which is in a period of 3 months, it could have been finished. If the system as it exists today was to operate, the first thing that happens, the tax guys go in, they freeze the accounts. You can't pay the guys' salaries, your employees' salaries, people leave. There's no one there to keep an existing business running, right? You have large customers, in that case all IT, whose first interest would have been, it's not easy to shift when you have whole back offices being run by a company, but the first thing you look to do is to shift to others. So the assurances that went out through government and others that this company will be left stable were critical to keep the company alive. So there are very critical first moves that need to be made to ensure that a company is able to survive that period with a view to helping both the banks and the company to take it to the next stage, which is what happened in Satyam when it moved to Mahindra's, and it exists as such now as Mahindra Tech, right? So we need more such mechanisms. So whatever we call it, but a strategic unit for large companies where the decision making is such that they have access to the highest levels in government and otherwise to allow for course correction before they are declared NCLT as well. And that will save the NPAs at the banks. But that's just a thought and a suggestion. I think the error we made was in allowing NBFCs to grow, we took a very light touch, maybe even a blind eye to, hey, NBFCs will not be regulated by banks the way banks are, by RBI, the way banks are regulated by RBI. And now we're sort of going in there and tightening that up. So yes, it was important that there was light touch so NBFCs grow, but to not keep a firmer eye on what was happening there, I think was in hindsight an error. And so we're getting a crisis at the NBFC level, which is coming back to haunt us as well. Because there is wild lending, there is lending to sectors, as indeed has happened to real estate, which comes back to haunt us. So the question I have is, we know that there's an issue in real estate right now. That is the biggest issue when it comes to NBFCs, and it hits the banks. The banks are lenders to the NBFCs, NBFCs are lenders to real estate. So what are we doing as a country to sort out the real estate sector? Because unless you sort the real estate sector out, you don't get resolution at the banks and the NBFCs. And I think we miss these linkages. We go after the banker, but we miss the fact that somewhere along the line, the issue was the underlying sector, which almost overnight, between demonetization and a new act called RERA, all in the right direction, happened too soon for the economy to be able to embrace. And so you get builders who are by no means guys who I hold a candle to, but you have to allow a system which moves and transitions from where it was to where it needs to be, and it cannot happen overnight because you dream it should happen overnight. And I think that transition time is what we have got wrong, and we've really messed up very critical sectors like real estate, because from that flows steel and cement and employment and construction and unfortunately now NPAs. So I think these linkages become very important to recognize and realize. Just on infrastructure, I thought it was interesting, but I shall quote Rajneesh Kumar, head of SBI, where he's at the FICCI AGM just now, December 2019. He says, I have not said no to any projects. You bring me the bankable projects, I will fund them. And he says, I've only had 2 projects that have come. And he wasn't saying bankable, 2 projects that have even come. HPCL in Rajasthan and the expressway that are over 20,000 crores. So right now, we don't even have projects which we're thinking are bankable enough to take to the SBI, let alone be funded by an SBI. So where is infrastructure in the country and the funding therein? He says in the working capital also has not even been drawn. So that's one. And then not only did he not say, but we do know, is the whole issue of criminal jurisprudence and the way it is impacting bankers. Which banker's taking a decision, which banker prepared to put a signature to a loan, when the fear of it coming back to haunt him 10 years later, and it's the same issue with bureaucrats, where the protection, when you take a decision with, it may be a faulty decision in hindsight, but taken at that point of time, and for no personal gratification. If you cannot establish personal gratification, then allow that loan to be seen as a risk that was maybe wrongly taken, but it isn't a criminal decision. Because right now, risk-taking in banks has absolutely fallen away. Nobody's willing to sign a file for the very guys who need the money. Everybody's signing the files for those that don't need the money because they have more than enough coming out of their ears. So I'll just leave it at that. And in terms of the future, we talked about digital loans. We talked about the regulatory environment. I hope we get a chance.
I think
to
we'll have a chance to come back to it. Now, thank you. This is a very comprehensive coverage, ma'am, and focusing on real sector issues as the underlying cause is, I think, a good corrective. Now I turn to Mr. Sinha. I want to explain to you why I'm coming to you last, sir. You are the only one perhaps in this room who has actually run a large FI. You've run a completely market-driven, board-governed financial institution, UTI. You've dealt with policy making in banking and capital markets for over 5 years, been a regulator for over 5 years. So perhaps you're one person who has a more than a 360 degree view. And in addition to the issues that have been dealt with, can I request you, I'll just take a minute. You will recall 94 to 2004, India legislated 10 legislations to deal with issues in the securities markets alone. And this is not exactly the most stable political times of India, almost entirely coalition governments. Every problem that surfaced, eventually, which if it required a legislative solution was found. 10 securities markets legislations alone. On the other hand, let's see what is happening now. FMC-SEBI merger proposed in 2004 formally, successfully completed in 2015. Inflation targeting, 1997 first report, successfully concluded in 2014. Something that you've been strongly advocating, appointment process for regulators, which is better than the non-transparent past, 7 years before the FSRAC was notified. I can go on. Corporate bonds, ma'am referred to it. We probably now can come, I think we can't count them in two hands. The number of committees that have gone into what needs to be done for corporate bonds in India. We'll need, I think, all 4 pairs of hands. So, and there is a very famous academic / regulator who in 2014 said, why fix what ain't broken? Now, I mean, this is broken beyond repair. Now, you have, like all good successful civil servants, sir, reputation of being a mitabhashi, minimal speech in public. Now, you've also been a student of physics, which is your speech is inversely proportional to the number of years of sort of experience you have. I want you to break that law today and speak candidly about all of these issues, because you've been center stage in most of them and have a terrific perspective. So we'll give you 2 extra minutes.
Thank you. You have given me a very difficult task, and since you want me to be frank, I'll try to be frank, but I must give one disclaimer, and I want people to realize that whatever I'm saying, please don't think that I'm talking about one particular government. My response will be over a period of time and the various types of governments that we have seen, and I will like to comment on the system of governance in India rather than one set of governance versus another. Governments across the world are very famous for reacting once it is too late. Once a crisis has taken place, once a crisis has occurred, then they react. And India takes the lead in this. There were a series of reports that we need a separate regulator for the securities market starting from early 80s. But it took a Harshad Mehta scam to ensure, and there were budget announcements, but it took a Harshad Mehta scam for government to come out with an ordinance to create SEBI. Law was pending for years, but an ordinance came in. And we didn't learn from this. 10 years later, when we had a Ketan Parikh scam, we had another set of ordinance to provide that the powers, investigation powers and other powers and penal powers of SEBI should be enhanced in a very big manner. 10 years later, we had another set of scam, the Sharda scam or the Rose Valley type of scam. And again, through an ordinance, various changes were made in the SEBI Act. And this last one is important because it was not one set of ordinance. The first ordinance lapsed, so there was a second ordinance, that lapsed, then there was a third set of ordinance. And it came to the credit of the subsequent government that they got the bill passed. Another example, and which is relevant for the discussion here, PFRD, Pension Fund Regulatory and Development Authority, was created as early as December 2002. I'm sorry, December 2003. But the bill was passed finally in 2013. So it took 10 years for the bill to get passed. So that is one very serious limitation which we have in this country. Other countries also have it. For example, the US SEC was created once we had the 2930 crisis in the USA, and we had the Sarbanes-Oxley Act when we had a problem there. They have also been following the same pattern, but India, the intensity and the frequency of such approach has been very, very large. The second point I would like to make here is that while in the first decade of reforms, which is after 91, the first decade, a number of laws were passed, a number of measures were taken, and Dr. Krishnan is right that most of it was done in a period which was not politically very stable. There were frequent changes of government. But let us also realize that those changes were very, very fundamental. It was like planting a tree. And once you have planted the tree, the second or the third stage of changes cannot be so fundamental. But in the second decade also, for example, reforms in the administration of stock exchanges through changes in the SCRA, that took place. And in subsequent decade, the important thing which happened was about providing new avenues for people to raise money, new avenues for people to exit from a project. And since we have been talking about infrastructure, I like to bring here the 2 or maybe 3 new avenues which have been created. I'm talking of REITs, I'm talking of InvITs, and I'm talking of municipal bonds. These regulations have been placed, they are there, but the success has been minimal. And part of the reason for this lack of desirable success is that the potential investors have not been very sure about the tax treatment. Every 6 months, every 1 year, we hear some noise that the dividend distribution tax, for example, will be dealt with in a particular manner, or whether it is a question of capital gains tax and how it will impact the foreign investor or the foreign pension funds versus the Indian investors and all. And you know, talking about infrastructure projects, well, there are a large number of infrastructure projects which are lying midway, granted. But there are larger number of projects which are completed and which are revenue generating. And it is a great learning from outside India, not necessarily from within, but outside India, that many of these investors, many of these entrepreneurs can exit these projects and have enough money to start a second or a third one. If you have developed an infrastructure project or if you have developed a real estate project, and it's doing well, it has been implemented well, but it will take you maybe 10 years or 15 years to get your money out so that you can invest the money in the next project. REITs and InvITs are an example through which this can be done. And there are investors who are very happy with assurance about the tax treatment, assurance about the macro, that they are willing to invest where they are likely to get about 8 or 9% on a long-term basis. So that has got affected. Municipal bonds, for example, I see hardly any progress in municipal bonds. And part of the problem is that the accounting system in the municipal bodies in India are not up to the mark. And one of the requirements is that the municipal body should not be in loss, and accounting should be good, and there should be a separate escrow account created for this. But I'll come back to issues of infrastructure because we are talking of InvITs and municipal bonds. While the point was raised about whether the decision of moving away from development financial institutions to universal banks was the right decision or not, And it was also rightly mentioned that there are many problems in that model. According to me, the most important problem was that the way those institutions were existing, they were primarily existing and surviving on low-cost funding. And if that subsidized funding was not available, they had no future. And after RBI, LTO was withdrawn and government had deregulation of interest rates, the writing on the wall was very, very clear that these institutions can't survive. So getting into a universal bank mode, according to me, was the right move. It was the inevitable thing to do. But who has stopped these institutions from creating manpower, creating trained manpower and expertise? Those who had it and those who tried to develop it, they have been doing well compared to others. IDBI, for example, was the best in the country, even better than ICICI in my view at that time. I'm talking of 2000, 2002 period. So far as the expertise and knowledge was concerned about appraisal of a project. But because of reasons that it had to go to the parliament and the system took its own time, it could not be handled. Another mistake which we have done in the infrastructure sector is, over the last 4 decades, we have created institutions to deal with infrastructure. And when that institution, and there were budget announcements, mind it, it's not that somebody just came together and did it. There were budget announcements. And we had the unique record that every decade we have created one new infrastructure financing institution. Nobody took any measure to find out what happened to that institution. And that institution merely did everything else but infrastructure financing. One of them turned into a bank, one of them has turned into a very serious financial trouble. So what happened to them? So we have, instead of holding those institutions accountable for what they were created, we just ignored them, we bypassed them, and we created new institutions whose performance also has not been up to the par. So we are, as a country, and I keep hearing, and like you said, there have been so many reports on corporate bond. There have been perhaps even more number of reports on infrastructure. I think anybody who is dealing with financial sector and who is still living has been part of one of such committees. So there is no dearth of such committees. But one after another, while these committee reports are there, what has happened? And I keep getting numbers that so much is required. We perhaps have got, we don't have our act together about how to get into long-term financing, how to attract long-term funds from India and outside India. And I'll come back to the first observation you made about weak consumer protection in the country. And I think you are absolutely right. The problem is that because of the weak consumer protection, the whole market goes back by at least 10 years. It requires that much extra effort to restore the trust. And we have seen it right from 1980s or 1990s, that one episode places us back by more than 10 years. And here I would like to bring in an element which is people feel shy of talking about that, and that element is accountability of regulators. While we always feel very happy to talk about independence of regulators, we feel shy. How do we talk about the accountability of regulators? What should be the method which should be brought in? I don't have a ready solution in this seminar to offer, but at least we should start talking about it. I think there have been examples after examples where many of, including the current round of financial sector stress that we are seeing, there is a lot that can be said about what the regulators could have done. Thank you.
Thank you, sir. Excellent set of opening remarks. Maybe I should clarify on behalf of some of us, we're not shy of talking about accountability of regulators. I think a lot of us are afraid of talking about accountability of regulators because those who did have paid such an enormous price in the past, perhaps part of the problem. But we have clearly 25 minutes left, am I right? 20 plus. So it's, I think, time to open this up. I'll take one from each side. Brief, introduce yourself, pointed, and if it's addressed to somebody in particular. Is there somebody with the mic?
My name is Shikha Mehra, and I'm working primarily in the space of blockchain technology. So all these issues that were raised, in fact, I've been studying that and I'm raising a policy question for the banking industry. Is it really relevant to still continue with fractional reserve banking? Fractional reserve banking was invented 500 years ago when gold was money and the gold digital receipt, the GDRs functioned as currency.
Okay.
So that's one thing. Second thing.
One question.
Okay.
We have lots of people. Mr. Berry.
Thank you. We have an opportunity here to get some insight into the interaction between politicians and the bureaucracy in creating these pathologies. So one of the points that Sinha Sahab made was the instability of the tax treatment. And this is not only an issue in the financial sector, it's an issue across the board. Can you give us some insight into why this happens? And what you consider to be the role of the civil service in countering poorly conceived ideas that come from the political class, or dare one say it, is most of the itchiness within the bureaucracy itself?
Thank you. Yes, sir. Listen here.
Hi, good afternoon, everyone. Binay here from Takshashila Public Policy School. My question pertains to this issue of moral hazard. Ma'am cited the example of Satyam. Now, isn't there an inherent risk of perpetuating this cycle of moral hazard in terms of taking the call of which institution to bail out or provide an underwriting? And also tied into that fact is the issue of RBI, although evergreening of loans that happened in those 2011 to 2016 period, was that not a major reason as to why we ran into this NPA mess? Thank you.
I'll go to the end of the side. There's nobody, then there was somebody at that end. I'll come back to you, Anupamji. Yeah.
I recently visited SEBI's Delhi office in Parliament Street, Bank of Baroda building. And when I was leaving it, I noticed another office. When I went in, it said Harshad Mehta Claims Office set up by Act of Parliament.
Custodian.
Yeah, custodian. Isn't it a shameful failure that 30 years, 3 decades after this event, SEBI has not been able to resolve this matter, even though it's no longer in the newspapers?
That's easy to answer. It's shameful, but it's not SEBI. It's a separate body created by an act of parliament. It's not SEBI. Anupam.
I've looked at the Satyam case, and in many ways, to me, it was the worst of India and the best of India. The resolution was. So I'd like to come to that, but address the real problem that we are facing. Before demonetization, I used to say the next crisis is going to be a race between the road sector and the power sector. After demonetization, I've changed it to say that the next crisis is between the power sector and the real estate sector. For all reasons that we all know, and people have read Arvind Subramanian, the NCLT route doesn't quite work. So a heterodox or unorthodox approach, which was what happened in Satyam, has to be adopted either officially or unofficially. In the case of Satyam, people who may not know, the way it was resolved was, the reason, was NASSCOM came in, government didn't have a clue, the NASSCOM was asked, and they took it over. Basically, all the top industry said, we'll make it survive, and we won't raid, and we won't pirate. It was a way to solve the coordination problem. The same policy problem, coordination problem, exist, and until you address those, you can't solve the real estate and power problem. So what sort of mechanism do you see, any of you, to break this logjam?
We can take one more question. Yes, ma'am.
Hi, my question is about sustainable finance and ESG funds. And do you look, maybe what are the challenges for us, considering our markets are probably not at that stage? Or can we look at it as a solution to raise capitals and also clean up our act in some way?
Okay. Thank you. We go in the same order. Sriram? Do you want to
raise all of this?
You can pick whichever of these questions. First one was, I think, fractional reserve banking and technology, since you spoke about it.
Yeah, so fractional reserve, if I understand you correctly, you're saying that provide more cash to the assets that you are looking at, and then try and build a security cover over it. Is that right? If you have the leverage ratio has to be controlled.
Yeah.
Yeah, so I know, yeah.
Make sure that bankers don't get sleep and actually don't indulge in reckless lending, like one of the issues that were brought up.
No, I don't think that is a solution, in the sense that if you don't take risk, you're not a banker. That is something that is there. And if you don't take risk in your, if everybody wants a 100% secure environment, we are going nowhere. Whether it's the consumer, whether it is the banker in some way. What exactly is required is to try and find a correct leverage ratio as to how much you can leverage on the cash that you've built. In the Indian context, you would find that due to the additional comforts of SLR reserve requirements, SLR and CRR, there is a much more secure reserve that is available to the Indian banking system, financial system. And that is one reason why the distinction between banks and NBFCs come into place, because NBFC is not covered by the reserve requirements in some way. So banks would imagine that they are highly regulated, and that's why they build in an additional security cover reserve requirement on that. So in that sense, I would say that to a large extent, both in the reserve side as well as on the leverage side, it is not bad. What has really failed, and to that extent, I would combine the question with the NPLs and the power and I think real estate sector which was there. It was not because the NPL levels were low in 2012 or 2011 or something like that. If you see the amount of restructured assets that happened during that time, we were in excess of 450,000 crores on the restructured portfolio. The problem was that infrastructure project financing was relatively raw, and we had in the banking sector growth rates in excess of 30% of that sector, because that was the emerging, evolving sort of sector in many ways. For us, security of a spectrum, whether it was secured, whether at all it was a security or not, was still something of a gray area. But then for all practical purposes, it was treated as a secured advance. And we have come a long way since that, to understand the question. The security, when you say land, for example, road constructions, if we felt that 75–80% of the land acquisition has happened, we felt reasonably comfortable that the road will be constructed. But the pitfalls, even if it is 98%, 2% land which is not acquired, will create all sorts of problems. So we have learned a lot. At that time it was not. And in some way, the forbearance which was given as part of CDR was to try and understand, create a way forward, in the sense that try and see whether these problems does get resolved in a couple of years or not. And that is why the number of restructured advances went high. And because they were unresolved, all of them fell into an NPA category since 2014 and onwards. So the question is not whether we should go back to the safety of 100% narrow banking, but the question is, how do you learn from these experiences? How do you make sure that your risk assessment is much more accurate focused and accurate to try and build on that.
Thank you. Ma'am, would you like to take question relating to moral hazard? Question from Binay, and the question that Anupam asked about the sectoral issues, closer to what you said about real estate, and actually they are almost opposite of each other in terms of solutions, but over to you.
And before I move to that, just on infrastructure again, I think let's not forget that we also had policies in the desire to create infrastructure where we said debt equity ratios of 4:1 and 5:1 were acceptable. So we had a race to the bottom, basically, already set in advance. So blockchain or not, why is it that the private sector that had the choice didn't enter the space? And there were sectors that were clamoring to be called infrastructure just so that they could get the leverage. And we may call it crony capitalism or whatever name we give it today, but the fact is a project with debt equity ratios at those levels, with cash flow analysis, irrespective of whether that road completion risk is there or not, I think would anyway have been an issue. But anyhow, moral hazard, absolutely an issue. And I think the biggest issue with moral hazard is agricultural loans, right? So you can keep giving loans and keep telling farmers they don't have to repay, and so who's going to repay? The same thing happened with credit cards, same thing happened with microfinance, where the political system steps in and says, stop paying, and the sector goes belly up. So moral hazard is a huge issue. I don't think a bailout like Satyam creates a moral hazard, because the moral hazard would have been if the guy who created the issue didn't go behind bars. The fact is, the old Satyam management was out. It was dealt with summarily, right? In rescuing the company, its employees and its customers, and separating it from the bad guy is what is good. So as you rightly point out, it was a good end resolution. But you're right, we have to be very careful about moral hazard and how we do not bail out the bad. We bail out what is right, but make sure that the guy who messed up the environment or the company is taken care of. But let's pick those guys correctly as well. Not every person who made a bad decision to lend was he may have been, in hindsight, we can say, a banker who didn't get it right, but he may not have been able to predict that suddenly coal supplies were going to be shut off by the Supreme Court or the government. He may not have been able to predict that there would be an economic crisis in the country. And so every decision that a guy takes at a point of time is not necessarily a bad decision because the loan gets bad 10 years later. There are many others who have contributed to that bad decision. So maybe they all go behind bars, in which case the country is behind bars. So I think we do need to look at moral hazard, but look at it very carefully in terms of what we call moral hazard and what not. Bailouts are important. They exist across the world. We need the mechanisms that can do it and do it well. And someone asked, what is that mechanism? I don't think there can be any one mechanism. We can have like a disaster control wing maybe sitting somewhere. It should not be in the ministry because nobody will sign anything. It should be a group that is empowered, and they can set up working groups by industry, because you will need industry expertise there to determine what needs to be done. But that go-to mechanism isn't there today. So you need that go-to mechanism, which can then resolve, it's typically income tax so that the oxygen is not shut off to the company by freezing of accounts, a legal system, the banking system, and of course the regulator being all on the same page to allow the company to survive. I don't want to miss the point on ESG because it's a subject very close to my heart. I think it's an important question. I don't think India and Indian companies can ignore, or the banking sector and the financial world in India can ignore ESG. ESG today is growing in its significance at the global level. And I sit on global boards where the big financial investors in those companies, the Norges banks, the Danish sovereigns, are all asking what the company is doing in the ESG space. So if you need funding, and where there's World Bank, IFC, I mean, you begin to look, the questions that are being asked on ESG are key. And we have to be part of that norm, or a whole important aspect of funding which will come our way will not be available. The counter to it is that beyond renewable financing for green bonds, for example, there are many areas in India, including our infrastructure projects, which become eligible or not eligible depending on the standards we set at the ESG level. So we cannot ignore that even while we look at that next round of financing. So it must underpin what we do, and whether the Indian banks get it or not, the global capital markets are going to drive it, and the global capital markets are shareholders in every publicly quoted company in India today, and they will dump the stock if that company cannot show that it is doing the right thing. I would just end by saying, blockchain, however you define it, at the end of the day, we do need the technologies that help us make decisions, but they can never replace decision making, and nor is everything about the old bad. We have actually, I think, in our financial regulators, SEBI and RBI, a huge amount of experience and people who we absolutely need to empower to move in a way that helps us going forward. So yes, there's much that needs to be done, but there's much that is good in our system, which is important. Can we empower those individuals and those institutions better with the technologies of tomorrow? Absolutely. Can we have systems which help us take decisions on credit better? Absolutely. Should we rely only on those systems to take those credit decisions? We'll have the next NPA problem, because you still need people who exercise mind and thought using the tools that are available to them through those data analytics and technologies.
Thanks, ma'am. So one question which is directly addressed to you.
Yeah,
Suman Beri Saab's question.
Yeah, I'll address Dr. Beri's question, and I also talk a little bit about ESG.
ESG, yeah.
Yeah. There are three things which I would like to point out here. One is an element of vision about what you want to achieve in the next 3 years, 5 years, 10 years. If you start reacting only to the issue at hand and you want some outcome in the next 6 months or next 10 months, then there is a problem. The second problem is lack of trust and mutual respect, mutual professional respect between government and the regulators. Unfortunately, that has been there for a long time, and I see no signs of that going away. And the third issue is with regard to capacity within the government and capacity within the regulators. Those are areas which have not been talked about very openly in this country. People try to brush it under the carpet, but we are paying the price for it. And I have examples. For example, when we had the InvITs and REITs regulations, the first issue which came was about whether when the SPV, where the assets are lying, those are being transferred to the trust and units of the trust are being bought, will there be an element of capital gains tax? It took a lot of persuasion on the part of SEBI to convince the government, both the Department of Economic Affairs as well as Revenue, that this is something which is desirable. Without that, it can't happen. So in one budget, we got that. The next issue which could not get resolved in the first one was, what about the impact of MAT? You don't pay capital gains, but will there be an incidence of MAT? That required one next budget. Then the issue came about dividend distribution tax, which had not been solved in the first two budgets. So it requires 3 budgets to solve this simple problem about what is to be done with regard to REITs and InvITs. And we are talking about investors who are very large, who have global experience and who are articulate. They have been coming to government and highlighting these things, but it took 3 budgets. But look at the things after that. Even after these were clarified, we often hear signs and noises that no, maybe this will apply to a particular type of investor, if an investor who is coming from outside India or from one particular jurisdiction. Why can't we have clarity on all this? So this is the problem. Coming to the question of ESG, and on ESG, I like to say that I like to recommend to CPR that they should also consider it as a very important issue for consideration, because corporate India, especially the big corporates, are going to face it, if not in the next 2 years, but in the next 5 years, definitely in a very, very big way. $33 trillion of global institutional money, which is 1/4 of the total global money, is today applying at least one filter, which is an ESG filter. And they are under pressure from their members, the pension fund contributors and all across the world. They are raising questions and they are putting demands. And now we have a situation where national governments and international regulations are emphasizing that the Paris climate goals have to be followed. There are jurisdictions, EU for example, they have said that they want that entire continent to be carbon neutral by 2050. And there are companies now we are saying, no, we will do it by 2030. So obviously, if there are companies which are sensitive to this and they are taking measures towards it, they will be able to attract the numbers. Unfortunately, while SEBI has come out with the business responsibility report and the integrated report, my feeling is that these have become very routinized and there is hardly any analysis which is being done in the country. The short point is corporate India, regulators, think tanks, all of us have to be alive to this problem, which is likely to be a major problem for us the coming years. Thank you.
Thank you very much, sir. We are close to the end of the session. I think Rohit had a question.
Yeah.
It's your.
I'm going to take the panel organizer's privilege of asking the panel one question, which is that, and this is a big picture question, that in the last decade, I think there's been some amount of deterioration in the relationship between the Indian government and private actors broadly. I think there's a sense of some amount of victimization complex, which has been recovering. I would like to ask the panelists maybe to list a few places or a few initiatives, whether it's through FICCI, whether it's through private conferences, all where there have been some rebuilding of confidence between the private sector and public sector banks and the Ministry of Finance, because I think we're at somewhat of an all-time low in state-capital relations, and this is something which really needs to be repaired over time for India to grow. And so where are these confidence-building measures happening, and who's doing good work on this front? Thank you.
The same sequence.
I get the first.
You start, and we'll ask former President FICCI then to respond.
Yeah. So largely, you see, both at the industry level as well as at the banking level, there have been a lot of discussions on it. But my problem is there are two sets of broad issues which are there. And one is what Sinha Saab said in terms of trust, right? He talked about trust between the government and the regulator, but trust at all levels. So you can say trust between the board and the management, between the bank and the customer, between the regulated and the regulator, between the employee strength of the banks vis-a-vis the top management. All across the system, there is a loss of trust, and that is something that we need to build right from our own house, and then go outside into it. Today, as head of the bank, if I know that a person has made a good commercial decision, there's no way I can tell him that I'll protect you. Right? And if I am not able to do it as the head of the organization, who has been appointed by the senior-most powers of the country, assuming that I am also, quote unquote, cleaned up in some way on the integrity fund. So I don't know what sort of trust am I going to lend to. So one of the things that is very, very clear is that, I still remember my first days in my banking in the 80s, 81, when I entered a branch and I was a probationary officer, was supposed to be a very, very a good recruit in some way. And I entered the cash room for which, cash department for which I was fired by the chief cashier. Because to get into the cash department in those days was a question of high trust and integrity. And for him, I was nowhere in that whole system of saying that you have no business to be here, right? Now, I'm not saying get back to that level, but but we have come to a situation where we don't trust anybody. Auditors, for example. There's absolutely no trust on the auditors between the regulator and auditor, or the auditor and the bank, and so on. So there is one big piece on the space of trust. The second is we have to get back to normalcy, right? State of panic always is not going to help. Today, when we say due diligence, we are actually saying forensic audit, right? No due diligence. You go take a proposal on a due diligence, he talks about things which we do in forensic audit, not in due diligence. When we talk about consumer protection, in some way we have talked about consumer protection, we are talking more about customer paranoia, in the sense that you give everything to the customer. Does it work that way? That, then the whole banking laws and practices would need to change, in the sense that the order of waterfall, or the order of, getting, doing lending has to be completely rewritten. So you can't go from one end of the system to the right. We have today board members being whistleblowers. Board members were supposed to run the companies in whatever good governance ways. They are actually going back and saying, putting it in the public domain and being whistleblowing it, in some way. So I think the second big piece is that we have to get normalcy. And as to what steps, I think there are many steps that need to be taken. There are very few steps that are happening because people are more intent in putting their house in order and trying to make sure that they are safe vis-a-vis the environment. I think I think there's one thing that probably CPR can as well look at.
Quick.
I think you've absolutely covered the issue on the witch hunts, and the witch hunts outcome is exactly what you have said. I just want to reiterate again that the economy being where it is, and I don't think we've seen the end actually of issues in sectors which are yet going to have resolution, that the immediacy of getting the mechanisms that help sort through industry-wide issues in a way where we can prevent more NPAs coming at the doorstep of the banks is going to be key. I still believe, though some of those solutions, frankly, are staring us in the face sector by sector. So they do require industry-wide solutions. Within that industry, certain companies that need that solution. Right now, one of the solutions which we are relying on, which I don't think is working adequately, is the group of lenders have to come together and determine the next course. But by the time that group of lenders, largely made up of public sector banks, A, have to agree, and B, somebody has to sign, and that somebody who signs has to now feel that they are not going to be held responsible 10 years later, that the nature of decisions that are being made, even in this collective, where 10 banks signed together, but 17 banks okayed a loan. In one particular case, I'm thinking of it, ICICI, but one bank gets shafted for it. So, there is some protection mechanism which has to be stated at the highest level, saying that when the lender group decides, and that lender group needs to decide within 1 month or within 2 weeks, that taking long to make a decision doesn't mean you've applied your head more. There's a logic which says, oh, because we wrote many notes and it went back and forth and we met 200 times, that decision is better, but at the end of it, the patient is dead. So I think that mechanism is really quite critical right now, and one where, bearing in mind the environment, where people who make the decisions want to have protection, we need to provide that mechanism, and we need to make sure it's very time-bound in terms of how we do the resolution.
Thank you. Sir.
I'll come back to my earlier point that we need to develop in this country an era of mutual professional trust. Let me give you an example. When the UTI crisis took place in 2001-2002, the whole system worked together, and very quickly decisions were taken. In fact, the final solution of UTI was given by an individual who was the governor of the Reserve Bank of India at that time.
It's a very good.
So the government and the regulators, they worked together and they found a solution. And I have written about this next point that I am going to make. I have written about it elsewhere. There was a mechanism called the high-level committee on capital market, financial markets. The person who was heading that committee, I have seen it for almost 7 to 8 years, that person, the governor of the Reserve Bank of India, used to take lot of initiatives to try and understand the problems of other sectors and try to come out with a coherent, consolidated plan for the government. But I have also seen that last 10 years, I'm not saying last 5 years or so, last 10 years or a little more than 10 years, they started feeling that they are accountable to their own sector. They stopped taking interest in other things. There is a message in it. Why did they do that? So the mechanism of trying to understand problems in their totality and find a solution, that approach has vanished. We have to rebuild that approach. Without that, how do we solve it? We have a major problem.
Thank you, sir. Actually, that's in a positive sense. It's actually a good note to end on. I remember hearing from those who were in the Ministry of Finance at that time, that fateful evening when you came back after that discussion in the governor's house, all that the then FM wanted to know was, does this have the approval of Dr. Jalan? And once the answer was yes, he said, now don't bother me with anything more. Convert that into a legislation and bring it before Parliament. So I think that's the kind of trust we are talking about. But interestingly, this is a sector perhaps which has seen more analytical committee and reform work than perhaps any other sector in India, and also seen an enormous amount of reforms in the last 20 plus years. It's also been a very nuanced movement. We started with reforming one subsector at a time, and then we realized in the early parts of this century that we need to look at the whole, because as you said, it is no more a securities market alone question or a banking alone question. It clearly, the whole thing hangs together. And we've also now reached a situation where we realize that we need to also reform the regulatory architecture. And I think the good part is we perhaps know 99% of the solutions. And strangely, what starts as a completely iconoclastic view in India over 10 years becomes the mainstream for no reason other than the fact that we've had 20 such seminars. So I think the good part is we know all the answers. Hopefully, there will be an opportunity soon where a lot of this can be acted upon. On behalf of CPR, on behalf of all of you, big thanks to all of you and a big round of applause. Thank you for being with us.